Hi everyone, we are now going to look at Chapter 15, Investments. In this chapter, we're going to be distinguishing between debt and equity securities and between short-term and long-term investments. We're going to describe how to report equity securities with what we call controlling influence. We're going to skip down to the procedural and specifically look at how we do the accounting for debt securities that are classified as trading, for debt securities classified as held to maturity, and for debt security investments that are categorized as available for sale. We will also look at the accounting for equity securities where the investor has insignificant influence and where they have significant influence. So where are we? What are we? We are the company that is purchasing either the bond of another company, a debt security, or the stock of another company, common or preferred stock. We're not selling it, we're the purchaser now. So what does the corporation do when they're buying debt or equity securities? So first of all, we need to make sure we understand what's happening here. Why would a corporation even do this? Why would a company do this? Well, they have extra cash and they want to make money on their cash, just like any other time a person would purchase these types of investments. Some companies are set up to produce income from investments, so that's their main way of making a profit. And companies make investments for strategic reasons, maybe to take over another company and grow their company, or sometimes they'll invest in another company so that they could help influence them in a business partnership. So there's different reasons why a corporation would invest in the debt or the equity of another company. Now, there's what we call short-term and long-term investments. Now, investments mean debt security or equity securities owned by a company. They're considered investments to that company. We can then further categorize them between short-term, those investments the company's only going to hold for a year or less, and long-term, those they're going to own for more than a year. And you could see a breakdown of some companies out there and the type of portfolio those companies have. So Coca-Cola, about 9% of their assets are invested in short-term investments. 18% of all their assets are long-term investments. So they own debt or equity security, so usually bond or stock of another company. And you can see Starbucks, Pfizer, and Microsoft's there. So just to give you some real-world connection, companies really do purchase the debt and equity of other companies. Again, short-term investments are securities, whether they be debt securities, which are typically bond, or equity securities, which are stock, that management intends. So this is all from the perspective of the company's management. They're the ones who decide if it's short-term or long-term. They intend to convert the cash, the item to cash within 1 year. And these items can be converted to cash within 1 year. Long-term investments, they're not readily convertible to cash, or they're not intended to be converted to cash within a year, or are reported, and they're also reported in the non-current section of the balance sheet, often in the investment category. So we talked about this back in Chapter 4, the classified balance sheet, and we said there's different categories of long-term assets. We focused on property, plants, and equipment. We also, in Accounting 111, talked about intangibles, which is another long-term asset category. Well, investments you're going to hold for more than a year have their own category in long-term assets, and they're called long-term investments. So when a company owns the debt of another company or the stock of another company, and they intend to own it for more than a year, they'll report the balance of those accounts in the long-term investment area of the balance sheet. Go back to chapter 4 and take a look at that. Now, as we said, there's debt securities a company could purchase of another company, or equity. So if you purchase debt, typically bonds, the owner is a creditor because they purchased the debt. They are now the owner of the debt. So the company that the bond or the note is in the name of owes the corporation that bought it, the creditor, the money. We're looking at this from the perspective of the corporation that bought the debt. So they may be issued by government, this debt security, companies, or individuals. We usually focus on individuals for purpose, or I'm sorry, of corporations for this chapter, and it's normally bonds that are the debt security. Equity securities, so what if the corporation instead buys stock? Now you are an owner of the company. You're not a creditor. Investments in shares of stock is your typical equity security, whether it be common stock or preferred stock. And these are only issued by companies. So the characteristics and the differences between the two types of securities. Both are considered investments by the corporation purchasing them. Now, how do we account for them? And that's the key. So once we understand what they are, then we need to determine how to do the accounting for them. And it's very specific. So we're first going to deal with how we do the accounting for debt investments when the corporation is buying debt, such as bonds. Then that's the first, if you see the pink area. So the first thing we ask ourselves is, what type of security did we buy? So we're going to focus on debt first. The next thing is, do we intend to hold it really short-term or long-term? Then, and this only, in number 3, only applies to equity investments. If we are the owners of the stock, what percentage of ownership do we have of the other company? But like I said, we're going to first focus on debt securities, debt investments, look at the accounting, and then we'll deal with equity investments. We don't have any kind of ownership percentage when it comes to debt investment because we're not an owner when we own the debt. We're a creditor. Now, when you are the owner of debt, you have to put the debt into one of 3 categories. And you could see those categories there. Which category do you put it in? It all depends on the intent of management. So it's really up to management of the company who bought the debt. Do you intend to hold these bonds until they mature? If they do, we put them in a category called held to maturity, and we have our own special accounting for that category. Or are we going to sell them really quick within a couple months? We're not even going to hold them a year. We're going to sell them very quickly. We call them actively traded. So if we're going to sell them very quickly, 3 to 6 months, we put them in a category called trading and do special, that has its own type of accounting. So those are your 2 extremes. You're either going to sell it really quick, trading, or you're going to hold it till the end, held to maturity. For all investments in between those 2 extremes, we have this other category called available for sale. And these are debt securities that are not going to be held till they mature or sold very quickly. Okay? Now, let's just talk really quick, just introduce you to them, to the equity investment categories. We have what's called insignificant influence category. Now, percentage-wise, that's usually when the investor owns less than 20% of the corporation, of the stock of the corporation. So we, the investor, if we own less than 20% of the stock of a company, normally we can't influence its operations that much. So we call it insignificant influence. So if your investment in your stock falls in that category, you'll do special accounting. Then we have significant influence. That's where your ownership percentage now may be above 20 to 25%. It may not be at 50% or more than 50%. More than 50%, you control the company because you vote. You have 51 votes, 51% of the votes. Once you have that, you control all decisions of the company. So from around 20% up to 50%, we have this other category called significant influence. That means you own enough of the stock that maybe you're not in control of all the decisions, but you influence the decisions much more dramatically than somebody who only owns 10 or 15% of the company. So you have your own special way of accounting for the investment if your equity investment falls into that category. And then we have special accounting, which we're not going to learn the accounting because that's for an advanced course. But when a company owns more than 50% of the voting stock of another company, they control it. So they have special accounting for that category as well. So each category really defines what type of journal entries will be done for that investment. And all investments will not fall into one category. You take it on an investment by investment basis, dependent on what type of investment is bought, how long you're going to hold it, what the company's, how much, if it's stock, what percentage of the ownership does the company own, and what overall is the intent of management with how long they plan to hold the stock, not sell it, or the bonds. So that's an overview. So let's take a look. Let's start with an example. The company Ling Company on July 1st paid $30,000 to buy Dell's 7% 2-year bonds with a $30,000 par or principal. So in the last chapter, we were Dell selling it. Now we're the investor buying it. So what does the investor do when they buy the bond? Well, in this case, and in all cases in this chapter, they're going to buy the bond at its par or principal. We're not even getting into making it more complex by having Ling pay more or less. In a more advanced accounting course for my accounting majors out there, you'll see what happens. But for our purposes, just to introduce you to how we account for a debt investment, the company will debit an asset account called debt investment, because this is an investment in a debt security, a bond, and credit cash for $30,000. Now this bond is going to pay interest to Ling twice a year, once at December 31st and once at June 30th. How much are they going to be paid? 7% on $30,000 every 6 months. So 30,000 times 7% times 6/12 every 6 months, Ling will receive, and remember, we're Ling, they will receive $1,050 of interest. So they will be debiting cash, $1,050, and to Ling, this is interest revenue. So they will credit or increase interest revenue, just like any other revenue. Now on their income statement, at the end of the year, Ling will have interest revenue of $1,050, and on their balance sheet, debt investments. Now we didn't categorize these yet, so we're just showing you the general way we debit the investments credit cash, and then record any interest revenue that the investor, in this case Ling, receives on the bonds. Now, when the bonds mature, Ling Company will receive the cash of $30,000 from Dell, so they'll debit cash and credit debt investments for the $30,000. The bond matured, there's no longer a bond, so the investment went away and Ling received what was promised them. So they received the interest on the bond over the life of the bond, and they received the principal when the bond matured. Now, that accounting, I'm going to go back there, okay, is how we do the accounting when we are going to hold the investment in the bond to maturity. So let me go back to our slide here. Here we go. So we just demonstrated this very first category, held to maturity. We record the bond at its purchase price. We record interest over the life of the bond. And then we remove the bond when we receive the cash. Beyond that, you don't do anything special. What if instead the company wasn't going to keep the bond to maturity? They're going to sell it quickly, 5-6 months. Now it will be put into this second category instead, called debt securities as trading. Now, again, it all depends on the intent of management. So if the company buys a bond, they have a debt investment, they are going to sell it quickly so that they can make a profit. It will be always listed as a current asset because you never plan to hold it for more than 1 year. A matter of fact, to be in this category, it's only going to be in there for a couple months. Here's the other major difference between held to maturity and trading. We always report any bonds in this category at their fair market value at the end of the year. So when we report the bond on our balance sheet, we don't report it at what we paid for it like we did under the held to maturity category. We report it at what it's currently trading at in the bond market. And we'll see that. And this last will make more sense in a couple minutes. Any unrealized gain or loss between the from the change in the fair value from what we paid for it to its current value is reported as a gain or loss within the income statement. So let's take a look. TechCom's portfolio of trading securities had a total cost of $11,500 and a fair value of $13,000 on December 31st, 2019. The first year the securities were held. Now, first of all, we didn't see the journal entry to record this investment, but take a few seconds and jot this down. I don't know when they bought this, but it had to be in the last couple months because it's put into this trading category. On the date they bought this, let's say it was October 1st, the company paid $11,500. So they would have debited debt investment $11,500 and credited cash $11,500. So currently in the company's general ledger T account or account debt investment, there's a balance of $11,500, what we paid for it. But the accounting rules say, and this came out in the 1990s, so it was around 1996, I believe, that they said if you have a debt investment in this trading category because you're going to sell it very quickly, and you still have it on your books when you're doing your balance sheet at the end of the year, you don't report it at what you paid for it. You report it at its fair value on the day of the balance sheet. In this case, $13,000. Well, if you're sitting there going, well, it only has a balance of 11,500. Yep. So what we have to do is determine how much needs to be added to report it at its fair value of $13,000, and that would be $1,500. So what we're saying here is that the bond increased in value from $11,500 when we purchased it to $13,000 by the end of the year. That's a gain, but it's not actually realized. You don't realize a gain until you actually sell it. You have the money in your hand. So we call it a not realized gain. It's just a gain from the fluctuation of the market price. But because we are told to report this type of investment at its fair market value, that unrealized gain is still reported on our income statement. That's why it says unrealized gain income. And we credit it. Now, a gain is like a revenue account. Okay, so we could have called this unrealized revenue. It's just that we use the word gain to describe things like selling an investment at more than what we paid for it, reporting an investment at more than what we paid for it. We don't debit the debt investment account directly. We don't go to that account and increase it. What we do is use a second account called the fair value adjustment. And it's an account that will be right next to your debt investment account. So right now, and I'm just doing a quick T account, my debt investment account has a debit balance in it of $11,500, what the investment cost. Now, if I don't do anything, when I make my balance sheet, I would have to report that investment at $11,500 because that's all that's in that account. Well, the fair value adjustment account, trading, whatever balance is in that will either increase or decrease my debt investment account. So right now, this is the first year, there is no balance in the fair value adjustment account. Since I need to increase the debt investment from $11,500 up to $13,000, I have to debit the fair value adjustment account. So I debit the fair value adjustment account trading for $1,500 and I credit an unrealized gain income because it goes on the income statement. That increases net income, that $1,500. Now you can see when I report current assets on December 31st, I'm going to have current assets, and there's two ways of doing this. You could show the full enchilada on your balance sheet. Debt investments at cost plus the fair value adjustment account gives me my debt investment at its fair value. Or you could just simply write debt investments trading under your current assets at fair value, $13,000. And then in the parentheses, cost is $11,500. Either is acceptable. But the big thing here is that debt investments in this category are reported at their fair value on the balance sheet, and any difference between cost and fair value is reported on the income statement. If it increases in value, you'll have an unrealized gain. The opposite could happen. It could decrease in value. Then you would have an unrealized loss. Now, let's go to next year. Assume TechCom sells trading securities that had cost $100 for $120 in cash. Okay, so now they took some of those debt investments that they had, not all of them, but some of them, $100 that they paid for, and they sold them for $120 next year. They would debit cash for $120 because that's what they received. They credit their asset account where they originally recorded the purchase for the cost that they sold. So of the trading investments, which ones did they sell? Those that cost $100. So credit. So they sold the investments for $120 that cost them $100. So in this case, they have an actual gain on the sale of debt investments. This $20 is reported on the income statement, but it's not unrealized. Now it's realized. So we just call it gain on sale. Now the opposite could happen. Let's say instead they only sold the investment here for $90. So I'm just going to stop sharing this screen and share a Word document. Let me just grab one here. So here's what they're saying. Whoops. Where's my, okay, share, Word. There we go. Okay, so I'm coming over here and I'm saying, okay, instead they sold the debt investment that cost $100 for $90. Well, now they sold it for $90. The cost was $100. So now we have a loss on sale of $10 because they received less for it than they originally bought it at. So in this case, they'll debit cash for $90. They'll debit loss on sale for $10. And loss on sale is like an expense, but it's reported on our income statement and it decreases net income. Gain increases, loss decreases, and then we would credit debt investment for the original cost. So I'll show you an income statement where we have these kind of gains and losses being reported so you can see exactly where they're going. Okay, so I'm going to flip back over to my PowerPoint. Let me share that again so we don't have any issues. Okay, let me go down. All right. Just do that. Okay, so, whoops. Bear with me a second. Okay, so that was the trading securities. Now, we do go through a couple sites for the held to maturity, but as I said before, these are debt securities, so only debt securities are in this category because they're the only ones that mature. Equity securities do not mature. They could be in current assets if the maturity date is within a year. If the maturity date is not within the year, then they're in the non-current investments or long-term investments. There's no fair value adjustment. And so we saw that already. That it was our very first illustration. That's how we account for a long-term investment. Yeah, held to maturity. Now, debt investment is in this in-between category. So we saw how we do the journal entries and record debt securities if they're going to be held for a very short period of time. Report them at what we bought them at, but at the end of the year, increase them or decrease them to their fair value, and any difference between what we originally paid for them and their fair value is reported as an unrealized gain or loss on the income statement. When we sell that security in the future, we report actual gain or loss on the sale. Same with held to maturity. Now, held to maturity, we're not going to sell. We're holding those things till they mature. So we report them what we bought them at, and when we get the money at the end, we take them off our books. But what about debt securities, bonds we buy that we're not going to sell really quick and we're not going to hold to maturity? We have this catch-all in the middle category called available for sale. So I'm just going to repeat it. Debt investments that are not classified as being trading or held to maturity. So where do you report them? It all depends. Okay, so if your intent is to sell these within 1 year, they're short term. Remember, trading, you're selling them very quickly, 5 to 6 months. So what about something you're not planning on selling? Maybe you're going to sell it in 8 months or 9 months. It's an available for sale category, and it would still be considered a current asset. What if instead you say, I want to hold it for another year or 2 years, and it matures in 5 years? Okay, then it would be considered long-term because you're holding it for more than a year. Available for sale securities, debt securities, are always valued at fair value at the end of the year, just like trading. But here's the major difference. Any unrealized gain or loss is not reported on the income statement. It's reported directly in the equity section of the balance sheet. It never goes into the income statement and is shown as net income. It kind of bypasses the income statement and goes right into equity so that it never affects net income directly. Take a look. So now we have here, Mitsu Company had no prior investments. In a current period, it purchased 2 available for sale securities. It purchased Apple bonds, and there's the cost. So right now, in our debt investment account that are in this available for sale category, they bought an Apple bond for $30,000. So there's a debit in that account for $30,000, and they bought a note from Intex that Intex owes the money on for $43,000. So their debt investment account in their general ledger has a debit balance in it of $73,000 because that's what they paid for it. But the accounting rules say when you have debt investment in the available for sale category, at the end of the year, report them at their fair value. Now, we don't do this for each individual investment in this category. We say, what was the cost of all of the debt in this available for sale category? $73,000. So we look at the fair value of each, but we add them together. So Apple bonds, this would need to be given to us. We're trading at $29,050 at the end of the year. Intex notes, if we wanted to buy that on December 31st, would have been $45,500. So the market value, or what these are worth on December 31st, $74,550, an overall increase in value. Even though the bonds went down $950, the Intex note went up $2,500. And we don't report individual unrealized gains or losses. We do it by category. So the trading category will have a journal entry, if we have any, and the available for sale. So what happens here? Just like before, we're going to credit an unrealized gain account. But notice it says equity there, not because it's stock, but because that's where this unrealized gain gets reported, the equity section of the balance sheet. It never goes on the income statement, even though it's a gain. And then just like the trading investment has a fair value adjustment, so will the available for sale category. And it works the same way as our fair value adjustment trading account works. The balance in this account will either increase or decrease our debt investment account. Since we need our debt investment to be reported at $74,550 instead of $73,000, we need the fair value adjustment account to have a debit balance in it. So it will be added to the debt investment balance. And then we can report on the balance sheet, these investments have a fair value of $74,550. So debit the fair value adjustment because the fair value increased. Credit the unrealized gain equity because the unrealized gain for this type of investment is never reported on the income statement. It goes directly to the balance sheet. So take a look. When Music City reports these available for sale investments, now I'm not sure if they're a current asset or if they're a long-term investment, depending on what the company decides to do, we just have them in the assets for now. Here's the debt investment is $73,000. That's what we originally paid for them, but we increased them for the fair value adjustment. So on the balance sheet, they'll be reported at their fair value of $74,550. Notice also on the balance sheet in stockholder equity section, we will have a line called unrealized gain on an AFS available for sale securities. And that's the major reporting difference between the trading category and the available for sale, where the unrealized gain or loss from the increase or decrease in market value will be reported. This is how we handle debt investment. Now, what happens next year? Let's extend our example for this category and assume that on December 31st of next year, Mitsu's portfolio of long-term available for sale securities now has a cost of $81,000. So they bought some more. They bought additional $8,000 in securities, it looks like, and the debt investment available for sale category now has a debit balance of $81,000. When they fair value that at the end of next year, the fair value of those total investments are $82,000. So they've only increased in value $1,000 during this year. Now remember what the fair value adjustment account is used for. The balance in that account is either added or subtracted to your debt investment account. So if our debt investment account is currently at $81,000 and we need it to be at $82,000, we want our fair value adjustment account only to have a $1,000 balance. So we need to make a journal entry to get it from a $1,550 debit balance down to a $1,000 balance. So you can see the journal entry. We will credit fair value adjustment for the difference of $550, and we debit that unrealized gain equity account where we originally credited it last year. So now the unrealized gain equity account will also have a $1,000 balance. So that is how we account for debt investments. We put them in the trading category and do the accounting accordingly. The key here is making sure we record them at their cost. Now also with the trading, if you have any interest payments, if you receive any interest payments, remember you still account for them like you did way back here. Okay, so you'll still debit cash and credit interest revenue. But we bypassed that when we were going through our other examples. But you would do that. But the other key is that you record any increase or decrease in fair value on the income statement as an unrealized gain or loss. Available for sale, the increase, they're also reported at fair value, but the increase or decrease in fair value is reported as a gain or loss directly in equity. And held to maturity, they're reported at their cost and not reported at fair value at the end of the year. You're always recording any kind of interest revenue for any of the categories because you're actually receiving interest revenue because you own a bond. Now we're going to flip to, what if instead we buy stock? What if the company purchases stock as their investment? Well, remember there's three categories also under this category. There's the category of you have insignificant influence. Then there's the category of significant influence. And then there's the category you control the company you own the stock in. Again, that's a great little bar, line, bar, whatever you want to call it, showing the ownership percentage. So if you own normally between 0 to 20%, under 20%, we use what's called the fair value method, similar to what we just did with our debt investment, to account for our stock or equity investment. The reason this is because you don't have a lot of influence. You're just a normal investor. You're just Joe Schmo who bought some stock and is trying to make some money. But once you start upping your ownership percentage in a company, you're doing that for a reason. You may want to form a business alliance with this company. You may want to try to influence them because they sell you product or you sell them product. There's something more to your reasoning as to why you're investing and acquiring so much of that company. So when you own between 20 and 50%, now you're more in this significant influence. You have a lot more voting power. You can't tell them what to do, but you can really influence it. So we do the accounting a little differently when you own this type of investment. Then once you own more than 50% of the company, you are in control of the company. And you do a special type of accounting called consolidation method. And the consolidation method, I just got finished teaching it in an advanced accounting course. And we do about 5 or 6 chapters on all the different ways of doing the accounting under this method. So this is a much more advanced accounting that we just talk about it a little bit, but we don't show you actual journal entries and things. If you're an accounting major, you'll see it. So let's first look at insignificant influence. So now the company's switching gears. They're going to buy stock instead of debt. When equity investments are purchased, they're recorded at their cost when acquired, and you also include any kind of commission or brokerage fees paid. Because you just can't go to the market and trade stock. You usually have a broker do it for you. And even if you have like one of these websites do it for you, they're still going to charge you a fee. So we add that to the cost. So ITI purchased 100 shares of Links for $7,000, and just assume that included the broker's fees. We debit stock or equity investments, $7,000, and credit cash. I like just debiting stock investment. Now remember, this company the investor has insignificant influence. They don't own more than 20% of the other company. ITI then receives a $10 dividend on this stock. When you are in this category of insignificant influence and receive dividends, you just debit cash for the amount of the dividend you received, credit dividend revenue. This is just dividend revenue. It's like interest revenue. It's reported on your income statement and it increases net income. Now, at the end of the year, just like trading and available for sale in our debt category, our debt investments, insignificant equity investments are reported at their fair market value. So what the stock is trading at the end of the year. So the fair value of this investment is $9,000. And this is the first year they bought the investment. So the investment increased in value, so the company will report an unrealized gain. All gains, unrealized gains or losses, so all increases or decreases in market value are reported on the income statement. So unrealized gain income means you're putting this on the income statement, this $2,000, and then just like the debt investments, the equity investments will have a fair value adjustment stock account. So, and just like under the debt investments, because we need to increase our stock investment account, It currently has a $7,000 balance in it because that's what we paid for the stock. We need another account next to it to increase it or decrease it to fair value. And that's the fair value adjustment account. Since we needed to have $2,000 more, we're going to debit that account. So we'll add the debit of $7,000 in the stock investment account to the $2,000 in the fair value adjustment account to report it on our balance sheet. And there's how we report it. So again, unrealized gains. So remember, unrealized gains and losses, whether it's the debt available for, or I'm sorry, debt trading or the equity insignificant influence, are always reported in other revenues and gains on our income statement, that other section. Okay. So now we'll take the stock investment of $7,000, put it on our balance sheet, add the fair value adjustment account so that we report the stock investment on our balance sheet at fair value. And you see two different ways, just like with our debt investment. And yes, you report these all separately because you have separate categories. Now, what you got to be careful of, just remember, this could be a long-term investment or short-term. We don't put it in a category here because they didn't tell us, but it would be either current asset if it's going to be sold within 1 year, or it's going to be a long-term asset on a long-term investment if it's going to be held for more than a year before it's sold. Now, what happens next year when they actually sell some of this stock? So when it's sold, the difference between what they sell it for and what they paid for it will be an actual or realized gain or loss. So we will take how much they sold it for, in this case, $800. How much did they pay for the stock they sold? $500. So they didn't sell all this stock, they only sold some of it. So since they sold it for more than they originally purchased for, they have an actual gain of $300. So debit cash to show they got the cash of $800, credit the stock investment account where we originally recorded the purchase for $500, the portion that we just sold what we originally paid for it, to decrease that account. And then the difference is put on gain on sale of stock investment, which again goes in your other revenue and gain section of your income statement. This is an actual gain. So pretty similar accounting to the trading investment when it's the debt security. And they all have similarities. It's just keeping what you do with what in each category. So that's why I'm trying to refresh you and remind you. Now that was purchasing stock. You don't have a lot of influence. Now we do the accounting a little bit differently when you buy equity, securities, and you own more than 20%, but less than 50 or up to 50. And that's called significant influence. And because you have more influence over the operations and decisions of the other company, the FASB feels you should do the accounting a little differently, and we call this the equity method. And it's different than the other methods. And here's what we do. We record the purchase of the company at its cost. So I'm going to make a T account in front of on my little notepad in front of me right now. Now they do call this equity method investment because that's the method we're using. You can still call this stock investment, but I'm going to go with what the book calls it. It's a stock investment, but we're using the equity method to do the accounting. We always debit that account for the cost, $70,000. So on the debit side of my T account, I have $70,000, credit cash. So this is Micron. Now Micron owns 30% of Star. Now here's where the difference really comes in. Because Micron has so much influence over STAR's operations. The FASB feels that Micron should report, or their investment account should mirror STAR's equity account. In other words, when STAR's equity account increases, the investment account over on Micron's book should also increase. When STAR's equity account decreases, or equity area decreases, Micron's investment account should also decrease. So how do we accomplish this? Well, think about what are the major increases and decreases to equity: net income and dividends. So let's look at net income first. When STAR, now this is the company Micron bought, reports net income of $20,000, here's what Micron does. Micron takes the $20,000 and says basically 30% of that net income is ours. At some point, we're going to get that back in dividends. How much? $6,000 of it. On the day that STAR reports this, then, Micron grabs their journal, debits their investment account, that stock equity method investment account, for their portion of the net income, or 30% of the $20,000, $6,000. And they don't wait till they actually receive it as a dividend to call it revenue. Nope. They credit a revenue account called earnings from equity method investment. That's a revenue account, and it gets reported on the income statement. The last method, we didn't call anything revenue until we got it as a dividend. Not so in this method. They say record revenue for the portion of the earnings that you are entitled to, Micron, and that's what they're doing. So they just increased their net income as well, $6,000. Now this account doesn't have the word revenue in it, but no, that's what that is. And it would be reported in the other gains and revenues on the income statement. Now watch what happens. So just to back up, remember, STAR's net income increased when they made that net income. So Micron's investment account should increase by their respective ownership percentage, or $6,000. Now STAR is paying a dividend. So Micron is going to be receiving a dividend. Now on 1/9, STAR pays a total $10,000 cash dividend to all their shareholders. So how much cash will Micron be getting? 30% of the $10,000, or $3,000. They're going to debit cash for $3,000, but they don't credit dividend revenue. No, they credit their investment account. They already recorded revenue as the net income was being made that allowed for this dividend to be paid. Remember, let me go back here. When the company earned the $20,000, which is where the dividend comes from, STAR said, okay, we'll show $6,000 of that, which is our share of it, in revenue and increase our investment account. Well, as they start receiving the actual dividend, debit cash, decrease your investment account, and also remember what's happening on STAR's books. When they pay that cash dividend, their equity is also decreasing. Their retained earnings is going down. So at the end of the year, after this is done, what will be the balance over on Micron's investment account? Well, $73,000. $70,000 what they originally paid for it. They increased the investment account for their share of the net income of STAR, and then they decreased the investment account for the dividend they received from STAR. It's the $73,000 then that will be reported on their balance sheet. There's no increase or decrease to fair value under this method. Now watch what happens. What happens when Micron sells the stock? So when sold, they're going to say, okay, how much do we sell the stock for? $80,000. And that happened on January 10th of the next year. So they debit cash $80,000. They credit the equity method investment, since they're selling the whole investment, for the whole $73,000 balance, not the $70,000 they originally paid for it, but the balance of that account. Since they sold it, $80,000, for more than the balance in the equity method investment, they will report a gain on the sale of stock investment, just like they would any other time they sell the stock or debt, and they actually receive cash on that sale. Now, does that normally happen? No, because if the company has that much of a percentage of the ownership of another company, they're usually holding it long term, which, by the way, most of these investments in this category would be in the long-term investment area. So our last category is what happens when the company owns more than 50% of the stock of another company. Now they're in control. They have the majority of votes. So the consolidation method is used when the investor's ownership exceeds 50%. Consolidation method is always a long-term investment, and it shows the financial statements of all entities under the parent's control. Now, before we go to that, what do we mean, the parent's control? I'm going to go ahead back over to my Word document, and I'll share that with you. Stop sharing that. Share my Word. Where is it? There it is. Okay. So, consolidation. Some terms we need to be familiar with. First of all, the parent is the corporation that owns more than 50% of the other corporation. And some corporations own more than 50% of 2, 3, 4, 5 corporations. They just don't, you're not limited to only owning more than 50% of one corporation. And when I say more than 50%, I mean of the voting stock. Let's put that in here, voting stock of the other corporation, because all the decisions are made by them. The subsidiary is the corporation that is controlled or owned by the parent. So I'll just give you an example. Disney Corporation, in reality, owns more than 50%, of ABC Broadcasting Corporation. They are two separate corporations. ABC Corporation is still a separate corporation from Disney Corporation. It's just Disney Corporation owns more than 50% of the voting stock, so it controls it. But at any time, that could change. Disney may say, we don't want to own them anymore, and they'll sell their stock, let somebody else own them, or maybe nobody will own them in particular. But the key here is that they are, the parent is a corporation separate from the subsidiary. So they both have their own stock, okay? So the parent has a general ledger, and the subsidiary has a separate general ledger. Remember, at any time, the subsidiary can be sold. So what if Disney went and just took and put all of their stuff together with ABC Corporation and never kept it separated? They wouldn't know who, what, where. So no, ABC Corporation keeps their own separate accounting. Disney Corporation keeps theirs. Here's where consolidation happens though. The rules say this: when a financial statement needs to be created, the parent will report their information and all subsidiaries as one financial statement set. And I saw this in action, guys, because I worked in a public corporation that owned subsidiaries. And here's what basically happens. Disney, in this case, the parent, will obtain all the adjusted trial balances of their subsidiaries when completing a financial statement. And what they do is they take all of the adjusted trial balances and put them side by side, combine them all together, and make one trial balance to create Disney's financial statements, or what we call consolidated financial statements. So that's what we mean when you see that term, consolidated financial statements. It's the parents, and that's always the name of the corporation on the financial statement, and all of the subsidiaries that they own more than 50% of the stock of. So I'm going to take you out to the internet so you can see this, and also see a financial statement. I'll stop sharing this of, let me see if I can, let me go out here. Okay, just bear with me. Come on, you. Let's move this out of the way. Okay. And hopefully you see the, let me go to Starbucks because that's always my go-to company. Most corporations, almost all that are public, will always be consolidated. They will always own more than 50% of the voting stock of at least one other company. So, ooh, Starbucks says they're in 2019 finished and up and ready to roll. So I'm going to go into financial statements. Take a look. Starbucks Corporation. Let me get to there. Consolidated statement. Consolidated statement of earnings. Consolidated statement of comprehensive income, which is a separate financial statement. Consolidated balance sheet. So this just isn't the results and the information for Starbucks company itself, but also all the companies they own more than 50% of the voting stock. Look at this, long-term investments, equity investments. There they are, right there. 396 million. Okay, so Starbucks has companies it owns. Let's see if we can find some information here. Equity investment costs. Okay, page 68. Let me see if they give us some detail in the notes to the financial statements, telling us who they own. Equity investments, let's see. As of September 29th, we had 50% ownership interest in Starbucks Coffee Korea and Tata Starbucks Limited India. These international entities operate licensed Starbucks retail stores. Additional disclosure regarding changes in our equity method investments due to acquisitions or divestitures are in Note 2. We also license the rights to produce and distribute Starbucks branded products to our 50% owned joint venture, the North American Coffee Partnership with the Pepsi-Cola Company. So they have a little bit more complex arrangements also that they report in here. But just to show you, yeah. And if you say, well, Starbucks is Starbucks, but they have separate corporations also. One's in India here, and Korea, that they operate in, that they bring their information back into the fold under the Starbucks name. If we go back up to note 2 very quickly, I'm not going to bore you with this, but let's see. Some of it gets kind of crazy. Let's see where note 2 is here. Come on. There we go. In the third quarter, we sold our company-operated retail business in Thailand. So they reduced some of their equity method. And then they bought some stuff, it looks like, in France and the Netherlands. So you can always go out to Starbucks and read about that. But know this is happening, and that companies do own more than 50% of the others, and we actually do the accounting this way. While I'm on here, let's go back up to the balance sheet and see if we can look at here. I'll show you very quickly. I just saw available for sale. Investments. Available for sale debt securities. Marketable equity securities. So this is those securities that they're going to insignificant influence over. Equity investments, where they exercise significant influence. How they account for fair value. So it's happening out there. It's just showing you it actually does. Let me take a look. Let's go up to the earnings statement. Okay, first of all, remember I said unrealized gains or losses from available for sale securities go directly to equity, and this is how they get there. They're reported on the other comprehensive income statement, and then they fly down as other comprehensive income or loss to the balance sheet. So that's the unrealized gain or loss on the debt securities in the available for sale category. Also, let's see if they may not have them listed out separately here. But they don't have them listed separately here. But gains or unrealized gains or losses from trading debt investments and insignificant influence investments would be reported in this area of our financial statement. Okay, so just to bring you out to the real world to see this stuff is actually happening, and this is why we're doing it. Kind of helps us to wrap our heads, I think, around it a little more. Okay, so just to wrap up the methods, again, when we purchase investments in securities, they can be categorized as short-term or long-term. Debt investments are either going to be put into a trading category. This means we're going to sell them very quickly, 3, 4, 5 months. We report them if we own them at the end of the year at their fair value, and any unrealized gain or loss from the value of it increasing or decreasing is reported on the income statement. If we're going to hold it longer for 2 or 3 months, but not to maturity, it goes in the available for sale category. They are also reported at their fair value if we own them at the end of the year. But we report any difference in price increase or decrease directly in the stockholders' equity. Unrealized gain or loss is reported directly in stockholders' equity. If they're held to maturity, we don't report them at fair value. We just leave them at their cost and report them as such on our balance sheet. And that means the intent is to hold them till they mature. When it comes to equity investments, it's the amount of ownership that determines what category the investment falls in. So if we own less than 20% of the voting stock, we're an insignificant influence. Those securities are valued at fair value at the end of the year. and the difference between fair value and what we paid for them is reported as unrealized gain or loss in the income statement. If we do have significant influence, we report them under this equity method investment, where we don't use any kind of fair value adjustment, but we saw there's special types of journal entries to record the investor's portion of the other company's net income and dividends. And then if we own more than 50%, we had a totally different method called consolidation, and we took a look at that on our Word document. Now, let's talk about this comprehensive income. Comprehensive income is exactly what it sounds like. Net income, the income statement, just reports items the FASB feel are very important for investors to look at when it comes to the company's overall ability to make a profit. The FASB feels there's certain items that are not or it would be irresponsible of us to be reported directly on the income statement and affect net income directly. These are called other comprehensive income items. Net income is always a part of comprehensive income. So there is a statement of comprehensive income. You saw Starbucks and you saw there was a different kind of things on it. They're usually the items that appear on the comprehensive income statement beyond net income are very complex items that as an accounting major you would learn about. But you are learning about one item, and we saw it on Starbucks. When we have an unrealized gain or loss from an available for sale debt security, that unrealized gain or loss would be either added if it's an unrealized gain or subtracted from net income to determine overall all the income or comprehensive income of the corporation. Since we're not allowed to put that unrealized gain or loss from the available for sale investment directly on the income statement, we show it on this comprehensive income statement, so that decision makers know, well, there was this other item that increased value in our company. We didn't report it on the income statement and put it in net income. Or it could have the opposite effect, a net loss. There are other items, as I said, and you could see some of the things there. A foreign current translation amount adjustment, which you learn about in advanced accounting. Some of our companies have operations or do business with other countries in foreign currency. You need to translate that foreign currency into the domestic companies, so the United States currency. Sometimes there's a gain or a loss from that translation. And something called cash flow hedges, which I'm not even going to get into with you. So these are more complex things that as an accounting major would learn about. They're just too complex for our class. But these are other items that would be reported in this area. Okay, so we don't really go through these items until the very last chapter. So I'm just going to kind of bypass them. And that is the end of chapter 15 and our discussion on investments. So please post any questions that you may have to the discussion board.